Yeah. Good evening once again. See, in today's session, I will take up capital work in progress. I may not go in the order as per the slide which I have shared, but we will cover all the aspects. I am trying to match with the timing on the topic so that it is not carried to next session. It will be completed in the same session. Okay. Now, today, important topic, capital work in progress, property under construction. You may know the definitions, but anyway, still I will explain once. Capital work in progress, as the name itself suggests, it is a capital in nature. That means the entity is constructing or developing some project which is being capitalized or which is intended to be used for its own purpose, then it is called capital work in progress. And coming to work in progress, it is like inventory. If it is a manufacturing company, then it is there will be inventory and in the raw materials, work in progress and finished goods. Similarly, like that, if it is a construction company, then there may be certain property which they are intending to sell. Okay, here there is a intention to sell the whatever they are building, manufacturing, constructing, whatever they are doing it, but their intention is to sell after completing the project. Here, their intention is to use themselves, self-use. Okay. Suppose if I am having a big company and I have been using, see, this is small examples, but still for you to easy remembrance, I am telling, I am running my company in a rented place. Now I am constructing my own premises. Then that is capital work in progress, where I wanted to have my corporate office and do my business from that premises. Then it is categorized under work in progress. And if it is work in progress, suppose if I am dealing in garment industry, then whatever in process material is there, not the raw material, not the finished goods, in between the stage, that work in progress, that I am completing that, I am doing that in order to complete it to the finished product and sell it in the market, then it is work in progress. Coming to property under construction, under development or construction, whatever you say, property under development. Okay. Or investment property. It is a investment property. This is popularly known as investment property. Why this is called investment property? Because here the intention of the company or entity is not to use by themselves. Okay. Why it is called investment property is they are not going to use this for their purpose. That is why it is called not to use by, it is called investment property. Okay. See, here it is, their intention is to use by themselves, and here their intention is, see, this is very clear, you all know this, it is regular in our day-to-day. Okay, in case of investment property, here their intention is not to use by themselves. Here capital work in progress, here their intention is to use by themselves. So to give an example for investment property, I will tell you, say for example, I have big factory, okay, say 10 acres of factory where I have been doing garment business, and now my business has come down. So there is a huge land around the property which I am not able to use it myself and it is being idle. In that cases, what I am going to do is, recently the infrastructure has developed, many IT companies are coming. So I thought I will say 2 acres of land, I will use it for some renting purposes. I will develop some IT infrastructure kind of building and I will rent it for 2 IT companies. In that case, I have started constructing that particular property on my land. Okay, then the purpose why I am constructing that property is not to use by myself, but to rent it out to somebody else, or I may end up selling also subsequently, whatever may be the purpose, but I am not going to use it for my business. In that cases, then it has to be categorized under investment property. So wherever it is not in completion stage, it is in the process of construction or it is in the process of development, then we are calling it as work in progress. In work in progress, if it is a capital asset, it can be either capital work in progress or investment property. Okay. Now, what are the steps? I mean, what are the things we have to remember while closing books of accounts? I will write this investment property because this is called investment property only. What are the aspects we should remember while closing books of accounts in case of work in progress? So we will leave this separate. Okay, right now whatever I am discussing is these two, capital work in progress. Okay. I mean to say, we are not right now. Whatever I am discussing, it does not relevance to work in progress. I am talking about capital work in progress. Either it may be own use or for others purposes also. For those aspects I am discussing now. So first you have to identify projects. See, this is not actually at the year end, but all these things, whether the person, see what will happen, we go for audit at the year end. Okay. Then suddenly we see so much of work started, so much of amount they have spent, so much of money has been spent for permissions. Okay. Before groundwork starts, there is huge amount is spent on permissions and all. Okay. So we will get to know only at the year end. Okay. So there are chances that the accountants or the company or entity whichever you are dealing with would not have done all these entries. Okay, that is the reason we have to see. If they have not done, we have to do it, get it done from them, or we have to do it if we are doing the accounting work for that particular entity. So first we have to identify various projects. So suppose if it is a single project, it is good. If it is different projects, then we should have project wise data. Project 1, project 2, project 3, project 4, like that. Okay. How we can identify the projects? See, projects can be identified phase wise. See, company will have some program. Okay. They wanted to complete by 2027 this particular building, 2030 this particular building. Then you can or the company management can say this is project 1, this is project 2, or they would have named some project also. Okay. So my point is that you should collect the data project wise, and the entries, that means whatever the expenses have been incurred, has to be divided in the project wise, so that we can monitor the project as per the plan. Okay. Now in the recent years, okay, now we got RERA also. So it is easy for us to identify the project because the company itself or the entity itself is reporting to RERA that this is their project. So each RERA registration can be taken as a project. It is very good idea to do that. The reason being, even RERA complaints also require project wise. For RERA project means each RERA registration, right? So even for RERA also, we have to report what is the amount of expenditure done till date, reporting the date of reporting, what are the collections, how much balance to be done, all these things are there. So if it is a RERA applicable project, then you can blindly divide the project as per RERA, or if it is not a RERA applicable project, then you can understand from the management and you can accordingly divide the projects as per the phased manner or as per the management's decision. Okay, so all the expenses, whatever are incurred, has to be divided as per the project. Okay, now coming to allocation of expenses. See, now you know there are some 10 crores amount is spent. Okay, if you ask me, it is ideal to divide expenses under various heads so that we will have track. See, even I am just trying to correlate my this particular subject with RERA. So because you would have seen RERA reports also. Okay, so even if you see in RERA, project cost or operations cost, which include actual project expenses, okay, then permissions, administration, and finance cost, right? See, RERA form 3, if you see actually even before also the expenses has to be divided under these heads for our monitoring purposes. Okay, I am just trying to correlate with RERA because you would have seen the reports. Okay, so if you divide all the expenses project wise under these heads, then it is easy for you to check budget versus actuals. Okay, it is easy to you to verify budget versus actuals, and you can see the variance report accordingly. Okay, because see, project cost is decided by one team. Okay, and licensing team decides the permission cost. Okay, and administration cost, again it involves salaries, overheads, office expenses. Okay, all these things will be there. And finance cost, again it depends on the finance team. Nobody is the owner, not one single person is the owner of these costs. So it is a combination of various departments and all, and it will be easy to take the reports from them, variance reports and actual costs, all these things. So it is always good to monitor the project under these heads, and this will also help us in reporting under RERA also. Okay, so whatever expenses have been incurred, say for example, in this example I have said 10 crores. Okay, so this 10 crores have to be divided project wise under these heads. So you can say project 1 this much, project 2 this much, project 3 this much, like that. Whatever number of projects are there, you can just list it down in a tabular form. This helps in reporting in financials also. Okay, when we discuss about balance sheet and schedule 3, we will go into detail of that. Okay, now coming to how these entries have to be done. Okay, whenever this 10 crores is incurred, if you are aware that this 10 crores is incurred for so and so project for so and so expenditure, then you will put it under that particular head under that particular project. It is well and good, then there is no adjustment entry. You have to just see and verify whether it is correctly posted or not. Now coming to common expenses like administration expenses and finance cost. Sometimes permissions also, not sometimes, most of the times permission is also a common permission. What will happen when they go for permission? They will take the permission for 2-3 phases together. Reason being, it will be cost effective than going individually for different projects in the same premises. If it is a different premises, then it is okay. But if it is in the same premises, then they will go for a single permission, though they construct it in a phased manner. Okay. In that case, the important thing is allocation of cost. Cost allocation. Next is, first we have to allocate the cost. How the cost has to be allocated. Now the cost can be allocated on the basis of area, right? That is the best way to divide. If it is pertaining to a construction, this thing, or if you are making some in-house captive machinery. Okay, your company is already into some mechanical this thing, and you are building some captive machinery. Then you can divide based on the cost, can be divided based on the budgeted cost. Okay, see, area may not be right always. The reason being, I am developing some captive machinery. I am building some machinery by myself in my office itself. Okay, like that 2-3 machineries I am doing it. Then in that case, on what basis I will divide the indirect cost? So I can divide the indirect cost based upon the budget of that particular machinery in the ratio of various machineries which I am going to develop. Okay, so you have to, the allocation basis has to be rationally decided depending upon the property or asset which you are going to construct. Okay, if it is building, then obviously you can go as per area, because the permission cost of construction, everything depends upon the area only. Okay, so first we have to take the total cost incurred, and then we have to divide all the expenses. This holds good for administration cost and permissions, if which is not directly to that project, wherever the common cost is there, that you can divide it, right? And coming to finance cost. Okay, how will you do finance cost division? You cannot do these two bases. It is wrong. Okay, finance cost, what you have to do is, you have to identify the cash flows. Identify cash flows. Then that means what date, to which project you have incurred, how much amount you have incurred. Like that, you have identified the cash flows on monthly basis, or depending upon the date of amount spent. It can be done on monthly basis or the date of amount spent. So suppose you have spent in project 1 in the month of April 1 crore. Okay, in project 2 you have spent in April 3 crores. Then you can divide the finance cost also as per that ratio, whichever the amount has been spent. Fine. Then at what rate? See, rate is also important. What will happen? You would have borrowed money from various sources. Okay, sometimes we, if you are not able to see the board, let me know. If you see sources of money. See, rate is also important. You cannot apply same rate to all the projects, because you would have sourced money from bank loan. like term loan and all, or you would have sourced from equity, okay, or you would have sourced from debentures, or you would have bank loan, equity, debentures, okay, anything else, or you could have generated your own reserves. Fine. So there are chances that you would have taken some unsecured loans also from group companies. Okay, so there are all chances that you would have sourced money under any of the sources, and say suppose in the month of April you would have sourced, you incurred 4 crores, but 2 crores you have taken from bank loan, and unsecured loan 2 crores you have taken, where this rate is, say, bank loan say 12% and unsecured loan is 16%. Okay, and this 12% and this 2 crores, when it has come into your company, how much to which project you have incurred, like that you have to draw the cash flow with rates and sources from where you have got the money, calculate the interest and identify the average rate of interest. Then that particular interest rate you have to apply and you have to take it to capital. I mean, you have to capitalize it. Fine. So this is how you have to divide the common cost and you have to take the respective expenses under each project. Okay, now coming to entries. So now we have understood how the in what way we can divide the projects and how the cost has to be divided and what is the basis of allocation of common expenses. Now I will go to entries. See, suppose finance cost you have decided that project 1 you will debit 50 lakhs, project 2 10 lakhs, project 3 20 lakhs, for example. Okay, now you have arrived at all these numbers whatever we have discussed and you have come to a conclusion working that this is the cost which we have to divide it to the respective projects. Now tell me, whenever you have paid this finance cost, okay, see, bank loan every month they debit, okay, and debentures you do it on yearly basis, okay, you may not do it on monthly basis, okay, debenture interest, okay. So whatever may be the periodicity of the payment, okay, what is the entry you are going to pass? Debenture interest account debit to debenture interest payable, okay, to TDS payable. Okay, this is what the entry you usually pass to the for the debenture interest. If it is a bank loan, then bank loan interest or term loan interest account debit to loan account. Okay. So this is what you make the expense entry. Then you make the payment, that is different. That is you know it. Okay. Once you make this entry, tell me where this to. Okay, these amounts are going and hitting P&L, right? These two amounts are going and hitting P&L at the year end. At the year end, what you do? All these account balances you will transfer to P&L, or you do that way, or you will directly take it to projects. See, you may tell me, you may ask me, sir, why I will take it to P&L? I will directly debit. I know the ratio now. I know the amount. So debenture interest total is 80 lakhs. I will directly say finance cost project 1 50 lakhs account debit, finance cost project 2 10 lakhs account debit, finance cost project 3 20 lakhs account debit to debenture interest sir, I will do it directly, I will not route it to P&L. So it is not the right way. See, all expenses, whatever may be its nature, okay, it has to be debited to P&L, and from debit to P&L, you have to take it to balance sheet. That is the right way of accounting. Okay, so whatever entry you regularly do, that is the right way, and it has to be there like that. Then what will happen? After year end, after I do all this working, okay, I have arrived at this ratio. Then what I will do? I will on 31st March, I will say finance cost project 1 50 lakhs, finance cost project 2 10 lakhs, finance cost project 3 20 lakhs, to debenture interest 80 lakhs. So I am routing all my expenses through P&L, so that tomorrow, by any chance, no department, either income tax department or anything, cannot say that you have not debited the expenses to P&L. Okay, I have debited to P&L. From there, I have taken to balance sheet. Okay, so I have claimed it as expense first, and then I have taken it to asset account. Okay, this is how you have to pass the entry, not directly to the projects. Whatever may be the expense, see, even administrative costs, which includes salaries, staff welfare, okay, rent, all these things. Okay, everything first, whatever entry you do, it has to be done in the same way. There is no change in that. After you identify their ratios, their allocated amount, then you can accordingly every year end you can take it to respective capital work in progress or investment property, whichever is applicable. As far as coming to work in progress, okay, work in progress. See, work in progress is definitely a item of P&L only. Okay, so without saying that, work in progress is always routed through P&L. See, like how we take opening stock. Opening stock may include finished goods, work in progress, or raw material, right? So it is by default, it is routed through P&L. So I did not give much impression on that. Whatever other in work in progress, if you have 2-3 products, again the same kind of allocation, all these things you will be doing for direct expenses. Okay, indirect expense, it is not required because it is always indirect. So after gross profit, you will take the, I mean, you will claim all the other expenses from all the products whichever you are dealing with. Okay, as far as indirect expense need not be bifurcated as far as the work in progress is concerned, because everything is, the gross profit is anyway coming to this. You don't go into cost accounting. In cost accounting, you do that, but not in financial accounting. Okay, remember that. So again, even in this capital work in progress or investment property, we should, I will tell you, I will write it down. That we will discuss in schedule 3 also. Again, this capital work in progress, CWIP, and investment property. We should have aging of each project, how long they have been doing it, and in how many years they are going to complete, and also expected date of completion. Expected date of completion. This is required for overdue projects, stalled projects, especially overdue projects. Okay, this we will discuss in schedule 3, but I am telling these workings are required for these two particular assets, and capital work in progress and investment property, aging of the project, and also expected date of completion for overdue projects. If the whatever they have budgeted, I mean expected to complete, if it is going beyond the date, then what is the delay also we have to, I mean, when it is expected to complete has to also to be reported. Okay, this is as far as work in progress is concerned. And we have discussed about finance, finance charges allocation also. In the finance cost allocation, the main point what I want to impress is that you have to arrive at average cost of finance. Okay, that is very important. From various, there may be various source of money from where you would have got. There may be you would have taken money from your sales also. So there the cost is zero. There is no additional cost incurred. Okay, all these things you have to identify and arrive at the average cost of the this thing. And wherever amount is spent for other purposes, then that will remain in the P&L only. See, in the given example, what I have given is the debenture interest is 80 lakhs and I allocated entire 80 lakhs to all the projects. There may be chances that the only 79 lakhs is allocated, 1 lakh is left over. That will remain in P&L only, which is being used for our regular overhead expenses or regular day-to-day activities. Okay, in that case, whatever amount left after allocating this particular, working this particular average rate and how the cash flow is gone, then balance amount will remain in the P&L only. Okay. Now let us take, I am not, as I told you, I am not going in the order of the sheet. I am going which can be completed in the given half an hour. Okay. Say provision for doubtful debts. Say provision for doubtful debts, we know the entry, bad debts, account debit to provision for doubtful debts. Okay, but we have to see how we can arrive this number. Okay, we have to take the aging of the debtors. Okay, we have to take aging of the debtors, and there may be, see, one is aging. Suppose if a regular customer is there, but he is not paying certain bills. However, he is dealing with the further business. See, there are 10 bills outstanding against X, for example. Bill number 1 and 2 is remained unpaid for last 2 years, 1 year, more than 1 year. But he is doing business and he is making payment for other bills. That means there is some issue with those 2 bills. Either he is not accepted those goods or services, or there may be some defects. So that is the reason he is not paying that. Okay. So you have to analyze in such a way. What we do usually: opening balance, closing balance, movement. Okay, opening balance there is already received. That is our assumption. But you have to see bill wise which bills are outstanding and for how long. Okay, that is more important. Bill wise aging has to be taken. See, now softwares are much equipped to do all these things if the data entry is correct. Again, we are coming to the same point. Every report or any report, not every report, any report, the accuracy of any report depends upon the data entry. What you punch in will be that will be the outcome of that particular report. Okay, output depends upon your input. If you put dust in the input, then what you get is only dust. Okay, so you have to see that the entries are done properly so that you can take the aging bill wise. Even Tally is providing this particular report if we are doing the bill wise entries. Okay, so you have to analyze these particular unpaid bills which are going beyond 12 months or something like that, and you have to take explanation why they are not paid by the debtor, and accordingly you have to make provision. And whenever, see, okay, good, you have made the provision, you are not making it is completely not receivable, you are just making a provision. Okay, then what will happen subsequently? Whatever the suppose company has rectified that mistake and the debtor accepted and he has paid that overdue invoices whatever there for more than 12 months. If he has paid, then you will reverse that particular bad debts. So you have taken bad debts which you have to reverse. So in that case, what is the entry you are going to take? Debtors account debit to excess provision return back. See, this is the provision which you had made earlier. Okay, this is the provision. Okay, now what you are doing? You are crediting it here. Here it is a credit balance in assets. Okay, this you will reduce from debtors. Okay, this will go to P&L. Fine. In the first entry, this will be credit balance in assets. Okay, and this will be in P&L of that particular year. In next year, suppose whatever overdue invoices were there by X, he has paid the one of the bills. So then, what is the entry? You are making good of the debtors again by saying that debtors not debtors. It is provision for doubtful debts account debit. Provision for doubtful debts account debit to excess provision return back. Again, this you are going to take it to P&L, and this will reduce your closing balance of provision for doubtful debts. Fine. So this is with respect to provision for doubtful debts. You have to always see aging with respect to each invoice, not on totality basis. And don't work backwards. See, usually there is another bad habit what we do. Easy. We make instead of, see, all these things has to be prepared by the accountant. He has to give. Okay. What we do, we don't put requirements to them. We will do ourselves to report it in our financials, which is not right. What we do, suppose opening balance is 100 rupees, current year sales is 30, amount received is 50, then closing balance is 80. Then what we will do, we will work backward. Okay, out of this money, this is received, this is received. Okay, this is the aging. So don't do that. We have to identify what is the aging of this 100, and accordingly we have to do the calculation. I mean, we have to see whether there is whether there is any overdue invoices. Okay. Fine. If any questions you have, you can ask me. Or you can put it, see, you have to be, I'm not giving chance in between the class because we have taking very short period classes, so I don't want to waste, and recording is also allowed, so you can go and check the recording also. Listen again, if you are getting any doubts, please post it in the group, I will respond. Okay, thank you.